My name is Joe Cusick. I'm VP of Wealth and Asset Management, as you know, and also, as was mentioned, yeah, Bernard, I know, so impressive, isn't it? That's scary. You better be good after that kind of intro. I would also be remiss that I'm also here on behalf of our partner, TradeSpoon. I work with the broker-dealer, Money Block, and Trading Block. Those are execution platforms for both brokers and advisors, and as well as self-directed investors. Vlad Karpel is with TradeSpoon. He is the founder of TradeSpoon. He's also an employee of AOS. Now, I do have a few disclaimers, but folks, I want to welcome everybody before I get into this in our discussion about Condors. And, you know, really what we want to achieve here today is to look at these fixed risk kind of opportunities to sell options. And we want to do it in an environment where we see that when implied volatility expands, which, gosh, today, finally, seeing a little bit of that. We're going to go over that. But now let me just jump into these disclaimers real quick, and we'll jump into today's discussion because I know we have a very short period of time, and I really enjoyed the last speaker, just, you know, again, listening to different perspectives. So as I said, Vlad Karpel, TradeSpoon founder, is also an employee of AOS, which does business as Trading Block and Money Block, a registered broker-dealer, FINRA, NFA, SIPC member, and a registered investment advisor. TradeSpoon and AOS are not affiliated companies, and the content contained in TradeSpoon is not endorsed by AOS. AOS has an advertising and marketing arrangements with parties that are not registered or regulated as broker-dealers, such as TradeSpoon, and as part of these arrangements, AOS may pay fees or provide other forms of compensation in exchange for marketing. Any content and tools provided by AOS in this video are for educational and informational purposes only. Any stock, option, or future symbol that's displayed are for illustrative purposes only. I know you've heard this before, and are not intended to portray a recommendation to buy, sell, or hold any particular security. The presenter of this video or any team member from TradeSpoon that might be participating today may have financial interest in the securities represented in today's video. Options do involve risk, so take an opportunity to read the characteristics and risks of standardized options. You can go to the optionclearingcorp.com website or MoneyBlock or TradingBlock.com websites to receive a copy of that as well. All right, everyone ready? Let's put the helmet on. The markets are moving. Actually, I'm just going to do a little update here. Let's see. It looks like the S&Ps right now. Wow, the spiders are down 3. Taking a look at the futures, I'm just going to quickly jump in just to kind of get an idea. Actually, I want to take a look at little volatility. So I like to look at the VIX futures, and I'm going to look at the DVIX futures. The DVIX futures are up about 4%, around 70 cents. So a nice little pop here today, getting over that $16 point level, $16 level at 16.5. So we got vol on the move. We actually haven't seen volatility at these levels since August, and actually late July and beginning of August. And so this is a pretty impressive move, and one that we're going to want to keep an eye on. But this is also an opportunity, because as volatility expands in the general marketplace, that means that option premiums are potentially expanding as well. That uncertainty or sense of potential violent moves, as that starts to increase that perception, there's opportunity then to potentially get into strategies that take advantage of that. And let's talk about that today. Now, condors, you're going to hear that term, and it's not a bird. I know you probably heard that joke, so I apologize. Condors are a strategy that you can deploy when you're looking to sell options, and our chief marketing officer just thought that that was absolutely hilarious. But it is it's one of those strategies that you're deploying, yes, to take advantage of selling options, but with a fixed risk, as you could see from this graphic. Now, there are 2 types of condors, so I want to first of all define them, and then I want to discuss which one we're going to touch on today. Now, a traditional condor is, again, a neutral strategy where you're using all calls or all puts, but you're using different strike prices in the same expiration. So in other words, if you're doing a traditional condor, it's just all calls and all puts, which means that you'll have a bull call spread and a bear call spread. Same expiration month, just different strike prices, and you're going to get a net credit for doing that. Now today what we want to focus on is the iron condor. All right? An iron condor is when you combine a bear call spread. What's a bear call spread? Well, if we look at this graphic here, it's selling a call here and buying a call up here. That's defined risk, right? So that's called a bear call spread or a call credit spread. You're going to combine that with a bull put spread where you're going to sell a put here and buy a put down here. Again, defined risk. You combine the credits that you receive for these spreads, that's your net profit. So basically, if the stock stays in between these two areas, which many of you have pretty much so seen before in the past, if you've ever gone to an options, discussion about condors, but believe me, today you're going to learn a few different pieces of information that's going to make this a lot more streamlined. The credit you receive is your max profit. Now you get to combine these two credits you receive. So basically it's those two credits and then the difference between these two strike prices minus that net credit or that total credit you receive for those spreads is going to be your risk. And you know what, John's asking a question. Is the condor just another name for a spread? Yes, John, it's a multi-leg strategy. As a matter of fact, let's say, for example, earlier this week, I might have looked at the level that the market was at, or maybe even late last week, thought it was really getting choppy. Volatility popped a little bit, so I sold the call spread when the market was still up, but it was hitting its head, right? That's selling into strength on the upside. Then all of a sudden I've seen the last 3 or 4 sessions where the market has actually pulled down, volatility's popped up. I've seen now an opportunity to sell into strength on the downside by selling a put spread. You combine these two spread strategies and now you have a condor, okay? And that's what we want to discuss today, is how do you actually sit there and say, okay, I combine a call credit spread and a put credit spread, right? Which, John, to your point, is just two spreads, and then we put them together and we call it a condor. Now, the beautiful part about this is that just about anyone on this webinar that is participating and has privileges to trade options in their brokerage account can utilize this very strategy that we're talking about today. And folks, this is a great opportunity to start learning how to sell options with fixed risk. And again, what do I mean by fixed risk? Well, I'm selling these puts and these calls. So I'm selling the $31 calls and I'm selling the $73 puts. Now I don't want to have the unlimited risk on the calls, so I'm going to buy a call. That's why it's in red, and I'm going to buy the $34 calls, right? So that's my cap here. Now, yes, granted, I know that these are two different underlyings, but just please stick with me on concept, right? I sold these puts, but I don't want to own the stock if the stock goes below that short put strike price, so I'm going to limit or buy protection down here. So I sell the 73 puts, and or sell the 78 puts, and I'm going to buy the 73 puts, okay? And so you see that I have limited risk, I have defined reward, right, with that credit received, and the expiration month, well, it's the same for all these, and we have different strike prices for the calls and puts. So what are the critical elements of the condor? First of all, what's your market outlook? You're sideways to neutral. For the most part, you're looking at it and you're saying, okay, I believe that the range is going to be staying in between the two short strike prices. All right? If you have that conviction, and again, the speakers that were just on before me were talking about some technical analysis techniques. I was getting it on the tail end of just basically talking about where are those support and resistance areas, where are those areas where the stock could start to swing and actually get into a mode where it's going to get into a trend. Well, basically, if you can look at the strike prices and see if support and resistance are coming into play. So in other words, if support is at the short put strike price, or about 1 standard deviation away from where the stock is trading, or the short call is where resistance is, and you have conviction now of that these two levels are not going to be violated, this could be an excellent strategy to go in and sell these options. But you're looking for a limited risk type opportunity. So what can you do? Well, that's where you say to make it limited risk to meet that risk tolerance that you have, you're going to buy the wings, right? And once you buy these wings, that's also capping not only your risk, right? It's also reducing some of your reward. But the fact of the matter is, if you have the convictions that it's going to stay in between these two short strike prices, right, and you are comfortable with the risk capital that you're deploying, which is the difference between the strike prices minus the total premium you receive, then you are meeting all the qualifications that you're looking for from your objectives and your risk tolerances, and it's fitting also your market outlook. All right? And again, as I said, profitability. If the stock is in between these two levels at expiration, this is great, right? Someone's saying, so reward to risk so bad, 200 versus 800. That may be true in your mind, but let me ask you a question. If I were to tell you that you only have a 20% probability of that actually working against you, or in other words, an 80% probability of being potentially profitable, would you look at that more convincingly than, let's just say, buying an option that's at the money, or buying a stock, or buying an underlying where it's no better than 50-50 or a flip of a coin, right? And we'll actually get into that, but that's what I want you to think about when you typically, and as you had just pointed out, Howie, is that last point, typically it has lower profitability. Yes, you're risking maybe 800 to make 200, but if I have a high probability of success, I'm going to do that all day long, okay? There's an industry that has actually thrived on that. It's called, well, you've been to Vegas and you've heard of the analogies, but the point being is that the term probability is something that you have heard more and more and more over the course of time. So let's actually put proof to the pudding. First of all, when you're thinking about strike selection, or in other words, looking for a stock that might be appropriate for potentially utilizing as far as a Condor, a stock that you might want to implement for a Condor. First and foremost, what do you want to do? You want to look at a stock, right, and look at specifically a chart. And what I like to do, and I am not a technician. The gentlemen that were on before were technicians. I utilize it to do a variety of things. And first and foremost, I use technical analysis to just look at a picture and give me a perception of what's going on. And in this case, I'm looking at a stock that basically has been, for the most part, over the last year, almost year, been in a pretty decent range, basically between 30 and 40. Right? It's broken down here, came back, broke down here, came back. So I'm looking at support and resistance at these levels. And really, I just look at the, I drew just a rudimentary line, but if you could take 2 points, connect them, and extend them both to the left and right, that's basically a trend line in my mind. So I'm looking for something that's basically shown that it's been in a trend, challenged, and got back into that trend. And this is pretty convincing. Now back here, this would be something that I would consider a downtrend, right? If you're looking at this. This is more of a consolidation. So I'm looking at racks, right? Rack-based hosting. What about using probability and standard deviation on top of this, right? As well as maybe some implied volatility perspective to basically help me in understanding what would be first and foremost the most optimal strikes to select, and second of all, what are my probabilities of being successful? Now, usually I have my partner on from TradeSpoon to talk about what they have to offer as far as their tools and tech and research that they have. But Vlad, due to the holiday, was not able to make it today. And so I apologize for that. But at TradeSpoon, they actually, and I can't talk too much about their technologies and whatnot. I can give you some educational background on it. But just looking at when I was, this was when Racks, this was a few weeks ago, but basically what TradeSpoon does is it gives you their support and resistance, right, and that's based on a 50-day time horizon. They're giving the short-term trend analysis and their buy-sell rating. The short-term trend analysis is for the next 50 days, and it goes from 0 to 10, 10 being the most bullish, 0 being bearish. And the buy-sell rating, again, is that longer-term rating that's based on your bullish or bearish. And when you're getting into the lower end of the scale, first of all, the time frame is usually around 6 months to 18 months. And 3 would basically be on the lower end of the scale, so longer-term bearish, shorter-term bullish. That means that basically you have a stock that looks like it's going to be staying in a range between 32 and 46 with a 61% probability over the next 50 days. All right? Basically what this is telling you folks is that these are the one standard deviation out of the money and in the money, out of the money levels, right? So in other words, if you were to sell the $46 calls, you would only have an 18% probability that it would finish above that price level going into October expiration. If you sold the $32 puts, let's say the $32.50 puts, you'd have roughly around a 20% probability of it finishing below 32. All right, so this can help you looking at this probability analysis that's offered by Tradespoon. This can actually help you in strike price selection. All right, and you can see that that's one standard deviation. Why do I harp on one standard deviation? Well, if I look at one standard deviation to the upside, so in other words, this price target of 46.63, that's basically telling me that there is an 84% probability, or roughly 82% probability in this case at this level, that the stock is going to be below 46.63. It's also telling me that there is a 80% probability, or basically an 80, let's just say, we'll say 80% probability that the stock will be above 32.41. And there's a 61% probability that's going to be in between both of these folks. So this is really giving you some convictions about probability analysis. This also, as you look at the risk reward that was mentioned earlier, this also now starts to put some context. Yeah, I might be risking more than I'm going to make, but I have a higher probability of success than doing something that's closer to being at the money or just buying or selling outright at where the current market is trading. Okay? And this is a probabilistic world, folks, so let's really start utilizing the probability so that we can make the best strategic decisions. Now, as I said, I want to look at volatility. And volatility is also going to impact first of all, the strike selection. What do I mean? Well, basically, I start looking at volatility at a 1-year, 6-month, and 3-month perspective. What do I mean? So basically, I want to find the 52-week low. And you're looking at a volatility chart here from Trading Block and Money Block. We have a proprietary volatility chart that you can take a look at. And the green line is implied volatility. This green dot is the 52-week low. This red dot is where it's currently trading. And if I look at where it's currently trading around 53 and it's 52-week low, which was roughly around, I believe it was around 30, let's just say 35, okay? You basically see that differential, so 35 divided by the differential here, which is basically right around 18. You're seeing that that's around and actually the lows were down here, so it got dipped a little bit lower here. But basically you're looking at the IV rank roughly, and excuse me, it was up at 60 when I was looking at this. It was basically up at 60, which is basically giving me an IV rank of 85%. What does that mean? That with the current implied volatility right around 60, 61, and the low right around that 35 level, basically implied volatility is 85% higher than its 52-week low. This is big for me. It's big for two reasons. And also, if I look at the 3-month, it was about a month and a half before this. The implied volatility was right around down here in that 35 level. So basically, in about a month, implied volatility is 85% higher. Why is that important to me? First and foremost, it's telling me that there is a forecast out there that's saying there's something potentially going on with this stock. Now, typically, that's going to be earnings or some sort of binary event like that. Also, as premium sellers, or in other words, someone that's looking to utilize a strategy like a Condor, an iron Condor, it's also telling you that the premium that you're about to receive, it's inflated, right? It's inflated over its 52-week low, and it's inflated off of the lows after over the last 3 months. So that's really telling you, pay attention, but know that the risk, as Howie had pointed out, the risk that you're taking on, you're going to get paid for taking that on. And, by the way, when you see that implied volatility starts to expand, that means that you can sell strike prices that are further out of the money. In other words, it's getting you outside of that one standard deviation range, which means that your probability of success goes to about 80% on the individual strategies. And when you look at both the strategies combined, in other words, selling the call spread up here and selling the put spread down here, right, at these levels, you're basically getting better than a 60% probability of potential success, or in other words, staying in between these price points. So when you have a probability of profit of around 60% or greater, especially when you're doing these types of strategies like the Iron Condor, that is ideally the sweet spot that you're looking for, okay? Your probability of expiring above these two areas, well, you're looking for something roughly around 20% or less. Again, it's meeting that requirement. And last but not least, the call options and the put options that you want to sell want to be about one standard deviation out of the money. And this is one standard deviation out of the money, right? Okay. So let's actually look at an example. Now that we have the probabilities, let's take a look at the P&L and just kind of understand how this actually works. So in this case, I'm going to be selling the $32 puts in the $46 calls. Why did I choose those particular levels? Because that's the one standard deviation out of the money, right? And it also basically gave me an 80% probability of success on both of these, or basically right around a 61% probability of staying in between these strike prices. So in other words, I can walk in with a pretty decent conviction that I do not believe that the stock is going to be below this strike price or above this strike price. Now, I don't want to have unlimited risk, right? So what do? I buy the wings. That reduces the net credit I receive. So the net credit I receive for this Condor is 33 cents. That's the most I can ever make, folks. All right, and as a matter of fact, I could take that into consideration as far as, and by the way, some of you might go, well, Joe, you know, this seems really risky because what happens if the stock, you know, you could get nailed on both these positions? No, you can't. At expiration, if you actually hold on to this particular strategy until expiration, both these options cannot be in the money. All right, I just want to be abundantly clear. They cannot both be in the money at expiration. All right, the other thing is, too, you see that I collected 33 cents per contract. That's one of the other rules that I have on entry. Not only do I look at the one standard deviation, not only do I look at the fact that I want to have a probability of success of 60% or greater, and I want to be selling individual credit spreads with basically about an 80% probability of being potentially successful, but I also want to take in enough credit, right, to and these are $1 spreads. I want to take at least a third of the width of the spread in. Okay, and I do believe that these are being recorded, but we can confirm that at the end of the day, at the end of this session. But I want to take a third of the width of the spread. So what's a third of a $1? Well, that's 33 cents. So I'm collecting 33 cents. So that meets that criteria, right? My risk is going to be $67. It's the net credit minus the width between the strike prices, which is $1. So my net risk is 67. So I'm risking 67 to make 33. And yes, all of these are being recorded, folks. So you can see, right, that yes, I am risking twice as much as I could potentially make. But the fact of the matter is that basically I have about a 62% probability of success, if not greater, especially if volatility continues, if it is going to expand. Now, let's look at some what-if scenarios. All right, this is after we're into the actual strategy. The brass tacks what-if scenarios at expiration is, what happens if the stock is past 47 at expiration? Well, you're going to reach that maximum loss of 67 bucks. What happens if it stays between 32 and 46, right? The strike prices I sold. Guess what? I get to keep the 33 bucks. Max profit is made. What happens if it moves past $31? Again, that'll meet the max loss at expiration. One other risk management component that I want to talk about, or maintenance component that I want to talk about, if I sell this particular Condor, right, for 33 cents, one thing that I will do is that if the spread is trading at a 50% profit, or in other words, it's trading at right around 16 cents. So I sell it for 33. If it's trading at 16 cents and it's before expiration, I'm pulling it off. I'm going to take my 50% profit. All right. If the underlying, and again, I can give you some other ones, but it basically, I'm going to pull profits on this once it's trading at a 50% profit or greater. All right. The other thing that I want to point out is that you got to manage the untested side. In other words, let's say that rack space goes, let's say it goes from the $36 level or $37 level up to 43. Well, the puts are no longer tested, the $32 puts, the $32, $31 put spread. So what I would do is I would buy back the 32 puts, and I would look to potentially sell the $33 or $34 puts, and I would actually roll that up to like the 34, 33 put spread to see if I can't capture another 15 or 20 cents. That's if I still have the conviction that I do not believe that it's going to go through that short put strike. But the bottom line is that you always want to manage the untested sides, not the tested sides. What I mean by that is most of you, if the stock were to move up and you start to test that call credit spread, that's where you're focusing because you're like, oh my gosh, I'm going to start losing money. No, that's not where you want to focus on, folks. You want to focus on the side that was working for you and no longer is, and you want to roll it up, or you want to close the whole entire portfolio position, but we'll get into that as far as taking profits early. Max profit is only going to be realized at expiration. All right. So if the stock and if the stock is between the short strike prices, if you want to get max profit, you're going to have to wait until expiration. I recommend that when you are deploying risk capital, the most opportune time to take profits with these types of credit strategies is at a 50% mark. You've heard it from other places. I've talked about this for the last basically 5 years. You can look at all the different stuff that I've had out there, but for iron condors of this magnitude, I have consistently pulled profits off when they're at the 50 to 75% level. In other words, I've taken, or in other words, the credit I sold it for, it's 50% less or 75% less than what I originally sold it for. Can you take profits early? You bet. Okay? If the Condor were sold for 33 cents and it's trading at 10 cents, folks, why sit on that? There are going to be better ideas that you're going to be able to come up with, and why sit on it for just a dime? All right, you could take 70% of your profit target off. Don't be stubborn. And as a matter of fact, that sweet spot is 50%. We do not suggest using stops with spreads. Rather, size the trade to the percentage of either option buying power or percentage of cash available. We suggest somewhere between 1.5% and 5% of the total, either percent of option buying power available or percent of cash available, or you could do percent of portfolio. Okay? But use that versus trying to stop out of stuff. I don't suggest doing that with spreads. Well, I know I had a limited amount of time today, so I do want to offer the opportunity to type in some questions. I do want to thank everyone here for allowing us to talk to you. And as a matter of fact, if I can get this web, I'm going to actually, if you have any questions or considerations, you want to talk to me directly, you can always email me at support@tradingblock.com. You can also get a hold of me at support@moneyblock.com. And as a matter of fact, for everybody on this particular, on the webinar, I want to do something real special for you today. I talked to Vlad Karpel recently from TradeSpoon. And, you know, TradeSpoon has a remarkable layout of research and great comprehensive tools for finding trade ideas, assessing probabilities, and, you know, it's a great complement to the execution components. But this is what I want to do for everybody on this webinar. What I want to do is I want to offer you the ability to come trade a trading block, and I'll cut your commissions to $2.50 and 50 cents a contract. So the very spread strategies that I talked about, a Condor, that's 4 total contracts if you do a 1 lot. That 4 total, that Condor will cost you $2.50. I don't care if you're trading at IB. I don't care if you're trading at Thinkorswim, at the new Trade Monster Option House, Trade King, or Options Express. You are not going to be able to do a 4-lot strategy for $2.50. All right? You're going to be paying $4 or more. Okay? So I'm going to cut your commission costs to $2.50 minimum. So basically, if you do a 2-lot Condor, right, which means 4 legs at 2 contracts, that's 8 total contracts. That means for 8 total contracts, you'll pay $4. At IB, that's $8. So that's a 50% savings just from trading here at Trading Block. Also, Vlad has told me their elite service. Now, what is their elite service? This is a service that offers picks and ideas that you can go and research and potentially execute. Now, there are 4 to 5 picks a month. So on average, you have at least 4 picks a month. They typically charge $97, and that if you are an elite TradeSpoon elite service, if you have that service, that means you have access to all their tools, all their research. All the other services have limited exposure to this. So the bottom line is that where it typically will cost you $97 or more, we're going to cut that to $67. So folks, if you open up a Trading Block account, if you open up a TradeSpoon account, you're going to be paying $97 a month for these services if you do 4 transactions a month with an average per contracts of around 5 to 6 contracts. You're going to be paying $30 a month in commissions and $67 a month for the technology at TradeSpoon. And you know, the really cool part is that if you can make that with what you're trading on, it pays for itself, clearly, as you can see. Now, I actually want to put proof in the pudding. I'm actually going to do something here. Excuse me, you're going to see all this goofy stuff that I have on here, and you're seeing my family. Yes, I have a boatload of kids, and as a matter of fact, as soon as I'm done with this webinar, I'm going to Detroit for a hockey tournament. Thank you. My partner was just so what I want to do here, and I'm actually going to log out here. So what I want to do here is that I want to actually go in at TradeSpoon. They have a variety of different tools and applications, and you can actually go in. Not only can you check out all the different applications that they have, and Andre, yes, we do have portfolio margin. What's the minimum account size to open an account? Well, if you open up, if you don't want margin, basically it's pay as you go. If you want to have margin, it's $2,000. Is it possible to trade all strategies with you guys, like diagonals, butterflies, calendars, etc.? Aladdin, yes, totally. And you can do it in IRAs if you're here in the States. There's a few things that are pretty cool here at both Trading Block and at TradeSpoon. At TradeSpoon, you can go in and you can actually click on here. You can actually find candidates that could be based on their proprietary research. And again, I can't talk to it, but basically 5.5 would be those middle-of-the-road type stocks. Here are some names right here, right? And I am not recommending any of these. And again, if you have any questions on this, you can always email Vlad Karpel at info@tradespoon.com. And also, I know Joseph's going to be putting in a link to our offering. Joe, if you could put that in the chat box where people can get more information on this, but I'll also show them where it is. These could be 4 potential candidates that you could start going in and researching. So let me actually go in and put proof in the pudding, right? As far as Canadian accounts right now, we are in the process of looking to potentially get registered in Canada, but not at this point. In to win? Oh, wow. And you know what? That's our hockey phrase, in it to win it. So sorry about that. We are not open for rocks. I'm sorry, we're not open for Canadians at this juncture, but we're getting there. So if we go into analyze, let's just basically take a look at something real quick. And again, I'm going to take a look. 5 5s. These are very neutral. So it's short-term neutral, long-term neutral. I know, believe me, Rocks, I've spent a lot of time up in Canada. Too much. I'm up in Toronto almost every other weekend for hockey. So believe me, I want to get accounts up there as much as possible. And yes, Peter's saying the website shows that the commission for options is 75 cents per contract. That is correct. If you come off the street, that's what we charge you, Peter. But if you're a TradeSpoon subscriber and you're a Trading Block customer, you're going to get that cut to 50 cents and $2.50 minimum. Okay, so $2.50 minimum means that you're basically not going to pay more than $2.50 until you get up past 6 contracts. Okay, so this is a wonderful deal. So let's just basically walk through this. I'm just going to pull one out. KMB. I don't know it from Adam, but let's just actually look at it. Let's put the proof in the pudding. So KMB. And I'm going to do this. KMB. So if you click here, you can get the probability analysis, right? You can see that 101 and 113. That's the one standard deviation to the upside and 101 to the downside, and that's through October expiration. So I got 101 and 113. Okay, that's basically the one standard deviation levels. We can see that this is what the stock has been doing over the last year, and again, we're actually going through a revamp of our actual price charts. Looking at the volatility chart, I like to look at our table. The low is 9. The current is 1257, so that's 1251. So you're looking at this as roughly around 3.5 points. If you divide 3.5 by 9, you're basically looking at around the IB rank of around 33%. Okay, stock's down today around 146. So let's actually, and I'm actually going to go in here, and you know what? If you can bear with me for a second, I want to show you something. And I apologize. This is the Trading Block website, and I'm changing to here because this is where we can also use something. For those of you that want to actually test out the system, start walking through as I am right now, loading up trades and so forth. What I'm going to do is I'm actually, now that we know that vol is right around that 33% level, we see that the stock has basically been grinding. Actually, I'm going to go back to the chart and KMB. Okay, if we look at the candlesticks, you see that the chart right here, boy, this is a real good candidate. Look at this, folks. Support at 105. Resistance is coming in right around that 111, so we can even say that 115, right? This looks like a pretty decent candidate just from lining it up. I don't need any other technical analysis at this stage. I'm not using that. I've used the analysis from TradeSpoon and now also from Trading Block. And like I said, I'm looking at, now I want to look at the options. And here's the beautiful part is that I can go in and I can actually look at, let's look at the Condors. Okay, and what I want to do, and you can see how we have Condors, all calls. No, I want the iron Condors. All right, you can change the strike differential from 1 to 5. Now, I believe that KMB, and this is a $100 stock, so we're going to probably stick with the $5 interval and the mid-strike interval. Now, the mid-strike interval is basically where you're going to middle it. So if the stock's at 107, do I want to have it $5 higher or $5 lower? $5 lower gets me at about 102, right? And $5 higher gets me to a right around 113. Huh. All right. Doesn't that sound like about one standard deviation up and down? So that sounds perfect. Now you can change it to 6, okay? And then what we'll do is we'll actually scroll down. Now you have your October monthlies. You could actually go into November, but let's look at the Octobers. All right, and so you got the 105, 100, and the 115, 120. Let's take a look at this. So if you go trade, I'm actually going to launch virtual trade. So you'll see that we have virtual trade that's up and running. Okay, and actually I apologize. I need to go back. I should have done this from the get-go. So options, and you can see how quickly we can do this. KMB, we can go into Iron Condor 5, and we want to change the mid strike to 6. It calculates it quickly and easily for me. I go in here, I go trade, I put in quantity. Let's say that I want to do 2 contracts. Now typically 2 contracts, let's see, I'm going to do it at, let's see, it's $5, so I'm going to put it in, now one thing that you're going to notice here, folks, is that it's not meeting my criteria of 1/3 of the width of the spread. If I have a $5 spread between what I'm selling and what I'm buying, right, I need to take in about $1.60, somewhere around there. I'm only taking in about 70 cents. All right, so you really got to balance risk and reward. The other thing is that you might just tighten up. You might say instead of 5 points between the strikes. Now I don't know if they offer dollar strikes in this, but I'm going to actually try it. Let's try 1 points. I don't think they do. I think it's all $5. And yes, it's only $5. But let's just say for sake of example, again, I wouldn't do this now because it is, so I am going to be selling the 105s. And you'll see that I'm selling the 105s, buying the 100 puts. I'm selling the 115s, and I'm buying the 120s. So that's the defined risk. This is, and again, I can put in currently the bid ask, right, is the midpoint's around 67 cents. So let's say that I wanted to do this for 67 cents. Review the order. You can see this typically would cost $36 if you traded this off of rack rates. For you, right now, today, we're looking at $4 to trade this 8 lot. Okay, this would be 8 total contracts, a 2-lot spread, 8 total contracts. You multiply that times 50 cents, that's $4. So basically right there, you just saved yourself $28. Now, of course, our president just walked by and he's not happy with me. But, folks, you can see that I've now deployed this particular strategy. The one thing that I can note is that, yes, it didn't fit my 1/3 of the width of the spread as far as the total credit received, but it did fit all of the other credentials and criteria. All right? And that's how quickly and easily you can go in and do this. And you know what? Now you can go back and you can actually utilize the different tools and applications that we have both on our website as well as with our partners at Tradespoon. And one other note that I want to make about Tradespoon is it's one of the few providers of research and tools that find ideas that allow you to go in and actually look at the performance. Okay? So it's a really great opportunity to go in there, and if you have any more questions about either Tradespoon or about Trading Block, you can come to me for Trading Block at support@tradingblock.com, or you can go to info@tradespoon.com. And Joseph is going to, I know that you're going to be able to, and if you want my direct email, I got a couple people asking. Sure, it's my first initial J, Cusick @tradingblock.com. That will come directly to me, but also support@tradingblock.com comes to me directly as well. And as you can see, you can go in here, and if you're filled, you can go into Manage, you can go into My Positions, and you can start managing your positions accordingly. So this is a really fun, easy way to go in and utilize these strategies specifically to sell options, right? And then also, and for you Canadians, you should know TAP, that's Molson Coors, maker of my most favorite beverage of all time, Labatt's Blue. And the other thing is too, so Paul's asking, YouTube channel does not exist. Yeah, Paul, if you, also one other thing, if you want to listen more on upcoming opportunities with Vlad and myself, on the Tradespoon side, we have the weekly live broadcast. We actually do a live broadcast where we go over Wall Street's upcoming events like housing data, FOMC data, information. We talk about what's pricing in the markets. Then we'll actually break down a couple of the picks that they've done in the past or that are currently in play and break down how they're doing, give some suggested ideas on maintenance and any kind of opportunities to go in and maybe make some changes. And then what Vlad will also do is he'll go in and pick a tool and work through it, and so that you can really get basically from the perspective of the tool maker how this thing works. And then finally, something that we're very excited, we're actually going to have Dan Deming. Dan Deming is a partner from a group that, you know, they were former market makers, but it's called the Equity Armor Group. These are guys that used to trade. I used to trade with them on the floor, and now they've started a mutual fund that utilizes VIX futures and options, and it tracks the VIX, the futures VIX, not the cash VIX. Now, this is why you got to watch on Monday when we have Dan on. He's going to be talking about what's going on with volatility this week, what they're seeing going into this trading week, and I think it's going to be a great opportunity for you to you know, enjoy a real great trader's perspective on specifically vol. All right, so great. If we don't have any questions, I think I'm coming up on time. And Jim, my name is Joe Cusick, and again, as I said, if you have any questions or considerations, if you're interested in this offer, you can actually go to tradespoon.com, and if you go in here, if you go to services, we actually auto trade a lot of their picks, and so if you're interested in the elite service that they offer at Tradespoon, we'll auto trade that for you at Trading Block. What is auto trade? Basically, when the pick comes out based on the criteria that they put out there, we deploy it, and here's the best part about all this. We do that at the $2.50 and 50 cents per contract, and that's also $2.50 for stock and a penny per share. So you're talking about some of the best rates out on the street, and you don't have to come in with a six-figure account to get that. We want your business. We're building out the technology so that it's going to be second to none. And yes, I know we have some work on certain things, but you can see how I can actually deploy these ideas. And the beautiful part is that you can go out there and you can do this in all style of accounts as long as you meet the criteria, right? Whether it's IRAs or individual accounts, this is a great opportunity to find a site that really can work well and work well with our partner at Tradespoon. So with that, I want to thank everybody for being on. It's at 1:40, and I believe that I'm at time.